Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. Today's guest is the founder and chief investment officer at Bison Interests, a firm that specializes in opportunistic investments in oil and gas equities. We're going to be discussing the energy markets, get his outlook for oil and gas in 2024, and more. It's Josh Young. Great to have you back on the show.
Thanks for having me back.
Well, I want to start with a year in review of the oil and gas markets in 2023. What, if anything, surprised you? What went according to your expectations? And did anything change about your views when it comes to investing in the space over the course of the year?
So I came into the year sort of bearish natural gas because production was surging relative to consumption, and LNG export facilities were going to be coming on only starting in late 2024, and bullish on oil because the long-term undersupply in oil seemed to be catching up relative to the restart of demand for transportation that had been sort of paused during COVID, and then also due to sort of the natural growth in oil demand globally that's been around 1% a year over the last 40 years or so. And so the biggest surprise was the relaxation of sanctions against Iran, where we saw year over year about 800,000 barrels a day of additional production coming out of Iran and additional exports from Iran to various markets. And the lack of enforcement of sanctions on Iran really, I think, was sort of shocking relative to what's happened from a geopolitical perspective this year. And it's surprising they're still not being enforced, even as Iranian funded and trained Houthi forces are shooting at international container ships going through. They're going into the Red Sea or out of the Red Sea right now. So that, I think, was sort of the biggest surprise, which was negative for oil prices. And then secondarily, U.S. shale grew a little more than I expected, and well productivity didn't decline by quite as much as I expected, which was also negative for the oil price.
Yeah, I want to talk about the situation in the Red Sea a little bit later and its implications for the market. But at the moment, I'd like to look ahead to 2024. What are the main catalysts, in your view, that are driving the energy investment thesis as we move into the new year?
U.S. shale grew more than I expected, partly because of the surge in drilling rigs and in completion activity, as well as the improvement in well productivity in places that were sort of surprising, like in the Bakken Shale in North Dakota, where there was more success on infill wells and redevelopment of old fields than I expected and then the industry consensus expected. What I expect to happen is, with the U.S. rig count down by about 160 rigs year over year, I expect the lag effect to start to kick in, which is that you'd expect that production would slow from a growth perspective and then maybe even start to fall after maybe growing a little more in the first part of 2024. So that should be pretty positive. It looks like expectations are for substantial oil production growth in the U.S. For 24, and so I think the consensus is wrong and sort of reset too high. And then I think the other thing that's going to be really interesting is the OPEC assessment for demand, oil demand growth for 2023 was pretty accurate, and the IEA assessment was totally wrong. They were way too low for 23. For 24, OPEC has us growing demand by over 2 million barrels a day, and the IEA has global demand growing by about 800 to 900,000 barrels a day. And I think the IEA is totally wrong. And, absent a significant economic downturn, we're going to see substantial oil demand growth. So I think the disappointment in supply from shale, and again, I acknowledge I was wrong for 2023. I think I've identified where that happened and sort of what caused that, as well as sort of what's changed to slow that and to turn it around. And then, I think just demand is growing way faster than consensus is expecting. And I don't know why people are still using IEA estimates. They're wrong every year looking back, other than for 2020 when the world shut down from governments blocking travel and forcing people to stay inside. So those are, I think, the two sort of biggest factors for the oil market. And I think there's the potential for oil prices to shock to the upside to the extent that OPEC follows through on their stated cuts and doesn't bring more oil back onto the market, and to the extent that Iran just doesn't appear to be capable of growing their production by another 800,000 barrels a day in 2024. So without that incremental production, they may sustain production, their production may fall, sanctions may be enforced, they may not, but it seems like that sort of surprise is sort of off the table for 2024.
You took the words right out of my mouth when it comes to the IEA. Why are people still looking at that data? Obviously, they've made so many revisions. It's getting ridiculous at this point. Does the statistics they release, do they actually influence the market in any way? And why are market participants even paying attention to them at this point?
So, this gets to one of the reasons why I chose to start spending a little more time on, doing media like this interview. When you look at where people are getting information about oil and gas and broader energy markets, the sources of information have been compromised. So you have the EIA and other government agencies which are advocating for alternative energy and where possible mandating that people stop using fossil fuels, stop using clean burning natural gas in their homes, and forcing them into sort of riskier electric stoves and heat pumps and so on. And then you have the IEA and other sort of NGOs which are similar, and they're also advocating for this sort of energy transition. Rather than advocating for the growth of energy supplies, they're advocating for certain kinds of energy supplies, which is a pretty big deviation of their original sort of reason for formation, as well as their original sort of mission statement. And then you have media organizations, which I don't understand why they're not obligated to disclose this, but many of the media organizations and other sort of purveyors of this sort of information are running consulting divisions and ESG rating systems and diversity training programs and so on. And so you have almost these in some cases you have full on hit pieces on specific companies that it's almost like it's pay to play, where they're hitting them because they're paying someone else to do their ESG ratings. I think the question of why are people relying on this stuff, I don't know. I mean, why, we sort of shop around for the media these days that we like or agree with or aligns with our politics, which is unfortunate. And I think there was sort of more of a good faith effort of media historically to try to present multiple sides and to try to present accurate information. And unfortunately, I think that's less the case. And so I think what you see is anything that's sort of negative about the oil market or anything that's positive for energy transition is amplified to the nth degree. And anything that's positive, and you see this about sort of the general stock market and the economy too, doomsayers, broadly disseminated, easy to build a big following. I saw a podcast host talking about how they get 1/10 as many views when they have someone that's bullish on the economy and bullish on the stock market. And so similar sort of thing. Like the IEA is very bearish on oil and negative about oil demand and so on. And that's a view that's in line with the businesses of these media companies, and it's in line with the political and ideological agenda of government and non-governmental organizations. And so these things just get picked up and repeated. It's sort of like a bad game of telephone, which leaves people misinformed and shocked when they end up totally wrong.
Well, I know you believe that it's just a matter of time before oil prices reach new all-time highs. People on the other side say that there's a deep recession coming. Maybe it's going to be a deflationary depression. Maybe it's going to be a new great recession. There's a lot of pretty hyperbolic language being thrown around. But I'm wondering what your thoughts are there. Could such a scenario derail a demand for oil? And is there anything else? Do you ever think about the bear case? Is there anything else that could derail your thesis in the long term?
Yeah, I mean, I'm a value investor, so I actually sort of start with I have this picture of Buffett behind me, but and the bio of him. But I really I come at things maybe more from a Munger perspective. I invert everything and I try to figure out like what's terrible about this thing. And I think investment bankers and sales traders, they hate calling me because I'm just like no, 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 and I'll find like the problems with their stuff. And it's not that I'm a no guy. It's just that that's my starting point is, hey, let's like kill this idea. And if I can't kill it, or if the degree to which I have to go, the logical contortions I need to go to kill it are too ridiculous, then I get really interested. And so you start making money by not losing money, which is sort of a Buffett as well as sort of other like just a sort of risk taking. Reasonable mantra. And so, yeah, I mean, I'm always trying to find sort of the best, most compelling bear cases. The problem with the recession, I mean, there's many problems with the recession forecast. First of all, again, these things are very alluring. There's sort of this siren call for doomsaying. And there's sort of a joke. I think there's something to it maybe about how, when work weeks went from 80 hours to 60 hours to 40 hours to 30 something hours these days, it just freed up people to have more time and they spend that time brooding over imminent doom. And so, not everyone, but people interested in the economy, it seems like there's sort of an overlap between those folks. So look, like, is it possible that we have a terrible economic depression in 2024? Absolutely. It is possible. And in that case, oil prices will go down for some period of time. I think what we've seen is that central banks, as well as world governments, have shown us what they do when they're worried about a deep depression, which is they print lots of money. And it's not just the act of printing money, right? Money creation isn't just the thing. It's also they distribute it, and they distribute it a lot to their sort of political cronies and donors and whatever. But recently they figured out they can actually send it to poor people. And if they send it to poor people, they spend it. And if they spend it, then that's inflationary and also like very quickly restarts the economy. I mean, you think about the incredible dynamic of like the worst economic policy in history of forcing most people to stay at home. Not it was really a classist sort of horrible policy, but you had it was racist as well as terrible. Like you had people doing manual jobs that were forced to go to work, and you had the people like with laptop jobs staying at home. Horrible policy, right? Like maybe one of the worst economic policies ever, up there with sort of like Maoist cultural revolution, whatever. But they sent a bunch of poor people money, and sending poor people money kickstarted the economy. So by May of 2020, you were in an economic boom. At the same time, you had people like getting on CNBC crying, talking about how terrible it was going to be as they were buying stocks, right? So who knows, right? Like no one really knows what's going to happen. What we know is that policymakers have discovered or rediscovered sort of one of the tricks for a real sugar rush. And so, yeah, could oil prices fall? Sure. But the solution is right there. It's sort of a combination of what they would do, what they did in the financial crisis, which is bail out their rich buddies and protect banks and financial institutions and claim that their friends are too big to fail. And then send a whole bunch of money to people, which they did a little in 2007, 2008, but they did it in size in 2020. And so, if that's the case, then you almost want, as an oil investor, again, like you'd experience a lot of volatility. And that's, we named bison, we face into the storm like the bison. We understand that there's going to be a lot of volatility and we have a longer term view. If there is a downturn, we think it's extremely likely. I don't know if there will be a downturn. If there is one, it's extremely likely there will be inordinate money printing, even greater than we saw during COVID, which was sort of a manufactured downturn. And I think even with all the inflation concerns and all this other stuff, you'll see that all go away and you'll just see crazy money printing. And that would be incredibly bullish for oil as well as other commodities. And even on an inflation adjusted basis, it could be wildly bullish, particularly for the producers, which have some leverage, and the services companies, which have some leverage to that sort of price movement. They would benefit potentially disproportionately versus the commodity itself. So yes, I'm worried about it. Yes, there's a real risk. No, it's not very likely. And the reality is that people are terrible at predicting these things. Even people that like do papers on how it's hard to predict end up predicting doom and being wrong over and over again. This is a deep irony. There's some famous sort of TV personalities that I won't name that do this over and over again. It's shocking, right? They literally have books about how it's impossible to predict these things, and then they tell you how terrible they are. And there's pictures of them with like, plastic casing over their faces with like two face masks on, which apparently is like horrible for your respiratory system. So everyone wants to do it. I won't do it. But if it happens, I'm not worried because, it'll be really painful for a little bit. And then, COVID was one of the best things that happened to my investment, setup, right? I was able to redeploy into stuff and I did, it was terrible, very stressful during 2020. And it was amazing, from a 3-year return perspective, it was extraordinary. And so, from that perspective, no, I'm not worried. Yeah, it might happen. Yeah, it would really, really be painful and uncomfortable and stressful. And I'd get some more gray hair, maybe lose some more hair, whatever. But it would be extremely lucrative. And it's almost sort of the bull case for oil from the medium to long term is you want that. So that way they print. And the one other important thing from a supply perspective, sorry to ramble to answer this, is that you would have the rig count drop even more than you already had it drop, which would crush the forward sort of supply picture right as you're juicing the forward demand picture by, preparing to send people that will actually use the money. They'll go buy stuff and drive places and use gasoline and diesel and NGLs and all the other stuff. So, is that really healthy economically? No. Is this the right way to run economies? No. It's a terrible idea. It's a terrible way to do things. But it is, you sort of have to, there's the theory and then there's the reality. And the reality is that it would be massively bullish for oil and gas stocks over the medium term.
Are there any other, bearish scenarios that you've run through in your head? What would it take to send the long-term thesis into jeopardy? Would that be discoveries of massive new deposits? Would that be advancements in technology that allow for a greater extraction? What scenarios have you run through that could prove bearish for the long term?
Yeah, so there have been many, and the nice thing about the oil bear theses is you see them every week on the news. They come up with a different narrative for why oil prices are down or why they think they shouldn't be going up as they go up. So that part's you don't have to be that creative. You can just like open a newspaper or like watch financial television or look on Twitter or something. Various. There's the technology risk, both from EV adoption, which has slowed radically as basically the people that were open to trying it have tried them for the most part. The EV adoption rate, the growth rate of EVs, has slowed rapidly. And there are many folks that are actually starting to switch back as they have experienced sort of the cost issues as well as the logistical issues, which I guess were somewhat predictable, but sometimes we have to make mistakes in order to, on our own, in order to sort of fix them. And so, that was a really big concern. Frankly, Chinese EV growth, production growth was triple digits last year. And that was actually a really positive thing from an oil demand perspective. This year, that growth rate fell substantially. It was low double digits from triple digits. So if it had continued at triple digits, that would have been really scary. It did not. So that was really a big bear case, and that's been mitigated, as well as sort of evidence of huge numbers of EVs on abandoned lots, and those have even been picked up in media outlets that normally are pretty religiously pro alternative energy and electric vehicles, and so that's sort of how it's true, is when the XYZ media / financial information / consulting businesses share in their news stories. So that was a big one. Yeah, like big discoveries could have an impact, but the reality is, even if you found a giant oil field, it would take years to get it into development and ramp production. There have been some sort of bearish developments in shale, right? So Bakken, there was this sort of improvement in production. They've been finding sort of more oil in the Permian than people thought. They'll keep finding it, and the technology will keep improving. I think there's some low hanging fruit that was found sort of in the restart after COVID. So as the rig count started to ramp back up in 2021, there were a few technology improvements, as well as some things that people tried in terms of different zones and so on that worked. And I actually think those things sort of decelerate. And so the question is, are there more discoveries? Are there more of these innovations and so on? And there will be some, but it actually seems like the pace of that's decreasing and not increasing. But it's something I'm watching really closely, and I think it's a really good question. And then, there could be other sort of shale fields that people sort of figure out and dramatically improve productivity on and economics on. But even when you look at places like Argentina, where the Vaca Muerta is fantastic, there's so many challenges. There's water challenges and takeaway. And even though Milei was just elected and he seems really promising, he doesn't have control of the equivalent of their Congress, so he doesn't really have the ability to legislate. He's doing executive orders, but unfortunately, without their sort of Congress or Parliament, there was another president that came into Argentina, I think in 2015. He was president for a few years. He had similar sorts of ideas, and he just wasn't able to implement them effectively. So the political issues and other logistical issues globally that have slowed or prevented shale seem to be continuing. Those are sort of, I think, the big questions. And the reality is that you sort of need to have much higher oil prices, I think, to start solving some of those problems and actually creating the bear thesis. And I think we just saw this with uranium, where one of the sort of most loud, vociferous uranium bulls just got bearish on uranium equities, and people got really upset. And so I feel like there's going to be a moment, and I don't know how I feel about that exactly. I have minor exposure, right tail exposure, just in case it goes up a lot or whatever. But I think there's going to be a moment where I look at stuff and say, hey, this is scary and I want out. And again, I don't think we're anywhere close to that, but I think there's a decent chance that we reset to quite high price levels versus where we were, at least on a nominal basis. And we get to a level where people are feeling very comfortable, sort of like the 2010 to 2014 period or the early 1980s period. And I think that's the thing that's scariest to me, is people feeling comfortable with high prices, because I think we can construct a scenario where there would be another multi-year downturn for oil. We're just far from it, and we're really far from the equity valuations that we'd need, which will work well for me, because hey, when equity valuations are high when they've started low, and prices are high when they've started low, that's a recipe for fantastic success, I believe. There's no guarantees, and I'm not offering anything through this, but I think it could work out really well. So those are great questions. I really spend a lot of time actually trying to figure those things out, and I just keep coming back to most of those scenarios playing out through much higher prices over a multi-year period.
Well, I would like to discuss how you evaluate oil and gas companies, because for the average investor, it can be a pretty intimidating part of the market to wrap their heads around. So if a new company crosses your desk, you get a phone call. You said you like to look at the reasons why not before you look at the reasons why to invest. So what are the red flags that you look for? What is it you look for the bear thesis to begin with? And then if a company intrigues you and you're willing to dive deeper, what are the main things you're looking for before you make your final investment decision?
So I'm going to quote Joel Greenblatt, who ran one of the highest performing hedge funds. He didn't run it for that long. I think it was a decade or so. But when you look at these charts of the sort of best performance versus the longest period of time, he's sort of on the shorter period of time, but like one of the best track records of anyone essentially ever. And he, in one of his books, he said, investing in stocks without knowing what you're doing is like running through a dynamite factory with a lit match. You might not blow up, but you're still an idiot. So generally speaking, equity investing is hard. Most stock pickers lose money or they materially underperform the broader market or their sort of sector that they're benchmarked against. Most mutual fund managers underperform, most hedge funds underperform, and individual investors tend to actually underperform even more than that, unfortunately. So generally speaking, it's a loser's game. And so, we've done well at Bison sort of despite that. I think because we're focused on sort of these small, relatively illiquid, off the run equities in a sector that's very out of favor. So I think those are sort of a good starting point. But I can't emphasize enough the risk and uncertainty and the probability of loss associated with all of these things in any equity, in any sort of stock picking, in any sort of endeavor. And I'd ignore all the nonsense that you hear people put on social media or claim or whatever. The statistics are overwhelming. You can see them also from brokerages where they tell you sort of what their accounts do and so on without naming names, obviously. And, the data is just overwhelming. It's a really tough business and it's a really tough endeavor. And generally you just shouldn't do it. So don't try this at home. And frankly, probably don't try this professionally either. So you get a call, you say, hey, here's XYZ stock. So first of all, like where is it in operation? Most of the world presents, especially for oil and gas, unacceptably high risks. You may have seen various folks taking victory laps on individual oil and gas companies or other companies in unfriendly jurisdictions recently. And it brings to mind the 1,001 days in the life of a Thanksgiving turkey. It sounds wonderful and folks will brag about it. And occasionally they'll claim they took trading profits. And again, there's just overwhelming data that this stuff is just nonsense. And individuals may have done well on individual stocks, but generally, like what happens is you do well on something, you get greedy, you buy more of it because people treat stocks as gift and goods, which means they get more attracted to them as price goes up. And then as you feel most comfortable, the local dictator or the local parliament or whatever decides that this is theirs, not yours, and that's it. And this is the history of most oil and gas production in the world since inception. So where is it? And then sort of what's the geopolitical situation? And that sort of eliminates, from my perspective, most listed oil and gas producers, most interested in the US and Canada, and then a few international jurisdictions that have reasonable rule of law or something in their favor where it's extremely unlikely there's going to be a nationalization for some long period of time for various issues, or sort of expropriation, right? Like what we saw in Europe, where technically the countries didn't they didn't nationalize, but if you put a 99% or something windfall profits tax on production, you've essentially stolen it. So Ireland, UK, I mean, some of these places, like I think people should be aware of that too, just as an aside, not just for oil and gas. If they can do it to oil and gas, they can do it to any of your other investments. And they're basically just like, it's almost as bad as investing in like the USSR or various other, historical regimes that had no respect for private property. It's a red flag. It tells you this is not a place that's friendly to capital, and they're picking on oil and gas right now. They pick on other stuff. So anyway, jurisdiction matters. Management matters. In many cases, there's people that have done very poorly historically, betting on people that did poorly historically doing well now. It doesn't always fail, but the odds are not in your favor. So generally finding people that have been successful. The nice thing about public equities is you can not just find people who have been successful. You don't have to like back them as they're starting the next thing. You can find them while they're in the next thing, achieving success in that thing. And one of the better bets I've made is finding people that are doing really well, that have done really well, betting on them continuing to do really well on the thing that they are doing that they've done well doing. So it's like, I know it sounds like there's a lot of doings in there, but it's really just, betting on continued excellence by great people doing a thing that they are extremely skilled at, with a team that they are very capable of leading, with a balance sheet that's survivable, with a visible runway to be able to execute on that. So that's the best. And then there's sort of deviations from that, and then getting that at a giant discount to what it would cost to reassemble it using new capital, essentially the replacement cost, is very important to me. And there's many metrics, and there's, as you can sort of tell from how I'm describing this, every investment that we make at Bison is sort of its own sort of idiosyncratic thing. There's their own investment thesis. There's their own set of things that would drive success or failure for that investment, and all of it's oriented towards aversion of loss, in addition to trying to find potential significant upside. And every one of them looks different, so it's really hard to say, hey, we're looking for this kind of thing or that kind of thing. I'm looking for stuff where I'm very unlikely to lose money, where there's potential to earn a 10x or whatever. And the reality is you don't on most of them, but starting with really significant potential upside, really significant mitigated downside over the medium to long term. And then with occasional companies where there's a potential, let's say 100x or something, with the potential of fully losing capital and just sizing those very small. I think I don't know if that's helpful, but that's sort of the high level process that we use to select positions.
Yeah, absolutely helpful. And I'm wondering, how much do you think investors in energy need to pay attention to geopolitical and political events? Is it mostly just noise in your view when it comes to the long-term thesis? How much of an impact do those events really have on the market in the long term? Should investors even maybe block that out and just focus on evaluating individual companies if that's what they're doing, or playing the sector through an ETF, something like that, and maybe just forget about all this news about different things happening in the Middle East and wars breaking out, etc.?
So I think value can be its own catalyst to some extent. So if you can find a business that's doing well, even in a depressed environment, that's well run with a strong survivable balance sheet, I think that can sort of win the battle for you to some extent. But I think there's something that's sort of weird that's gone on with oil for the last few decades, where generally when people have bet to the upside on oil related geopolitical risk, they've lost. So what's happened is there's been this sort of Pavlovian response, both in terms of the financial response as well as the sort of narrative response. And so it gets to the point where if there's a event that actually has a reasonably high probability of affecting global oil supplies to the point where it actually could materially put oil out of balance, undersupplied, sending prices potentially to much higher levels for some period of time, people will acknowledge it and then bet against it and then laugh about it like within days before it's even sort of resolved. And the reality is, for any of these things, you don't really know how it's going to get resolved. So when Abqaiq was attacked, Saudi Arabia was hit by a number of missiles a few years ago. I think it was 2019, like sort of just before COVID. And there was 1.5 million barrels a day of production processing knocked out, and some of the fields were hit with some minor damage. There was a risk that actually Saudi wouldn't be able to refill their inventories and wouldn't be able to supply what they had promised to the market. And it turns out that they were able to, but there was, let's say, a 20% chance that they wouldn't have been able to bring that back online as quickly, that some of their reserve fields wouldn't have turned on quite as well as they did. And so I think there's sort of this false sense of security. It's sort of like most people don't short stocks, and we're not shorting stocks at Bison. We don't want to lose our clients' money. And, it's very risky and sort of a different longer term endeavor to short versus just finding undervalued securities with margins of safety and, various attributes that should allow them to outperform as a part of a portfolio. But people have been trained not to short stocks because for the last essentially 40 years, stocks, Dave Portnoy, stocks only go up sort of thing. So there's this like weird idea, and obviously that's not true. But over a multi-decade period, stocks have mostly just gone up. Oil prices have mostly just gone down relative to other prices, and oil geopolitical risk mostly hasn't played out. That doesn't mean that it won't. And it makes me inclined to actually be pretty bullish on it and to think that it might have a bigger impact than people think. Because if the Pavlovian response, if the financial win has been just sell it no matter what every time it comes up, then it seems much more likely that it's going to be mispriced and that there will be this sort of false sense of security, which makes me much more interested in it. And, I've talked about it publicly about sort of different events. And it's sort of funny because, there was this horrible massacre in October. And my take on that was, obviously the massacre was horrible. The political response, there was going to be a war, which might or might not affect oil supplies. And there was this downtrend that happened as oil futures had been sort of overbought. Speculative net interest was super high. And so that was already starting to wind down. And so my take on it at the time was, hey, I think this wind down is going to continue. I don't know how long it'll take, weeks, months, days, not sure. But, spike on this news, the wind down probably continues, but then there is some risk that this escalates, and depending on sort of how it plays out, it could actually have a material effect on the price of oil. And so that sort of played out, and now we're seeing some of the follow-on effects of what's happening there, right? The Houthis are attacking ships in the Red Sea, or entering or exiting the Red Sea, saying that they want to try to get Israel to stop the war in Gaza. So that's obviously directly connected, but it took a little while for that to play out. And I think people forget that, the oil embargo in 1973, it didn't happen immediately after the war. It took, I think it was a few weeks before they sort of started, and then I think it took a couple of months before it really sort of took effect. So I think these things can sort of lag. But the bigger thing is just everyone's bet against it for so long. Anyone that's bet on oil geopolitical risk moving price up has lost money, and that's an amazing setup. I mean, Munish Pabrai here, also one more thing on this. Munish Pabrai talked about Japanese stocks where he did so well on it. And he said, I went to one of his meetings, he said that where he was putting his position on at the time, he said the market in Japan had done so terribly that grandparents would tell their grandchildren that they should never invest in stocks because it had been so many, like it had been 3 decades since Japanese stocks had gone up. They would just, they told their kids, they tell their kids, it was known that you don't buy stocks. And that was an amazing setup. And he did so well on that. He's compounded money, I think 25% annually since he started his fund 15 or 20 years ago. And, a big part of that, now he's done well in his India stocks and Turkey stocks. He did great on his Japanese bets. And that's the sort of setup, I think, that sets you up very nicely to the upside, is this sort of, everyone knows, everyone thinks that you're an idiot or will laugh at you or whatever for saying you like this thing. Especially the people that are native to it and that are most involved. I love that. And, again, I'm not directly betting on oil. I'm buying undervalued oil and gas equities, but I thought your listeners might appreciate that story and sort of how it turned out, which was, I think some of his things went up like 10x or something over a couple of years.
Yeah, I'm in Japan right now, and to this day, retail investment in the market is incredibly low. Most people still think it's very dangerous to do any sort of investing. So that is a very interesting story. Now you did touch on the shipping firms, or you touched on the attacks in the Red Sea route. There's 4 major shipping firms that have halted their route after Houthi attacks against commercial vessels in the region. We just talked about how geopolitical events, when you're trying to bet on them when it comes to the oil price, it generally doesn't work out. But could this have an impact on the transportation of oil, potentially LNG? And if so, what are the implications for the energy market? Maybe this is an oil tanker play. I don't know. What are your thoughts there?
So actually, it looks like right now the way this is playing out is that container ships are getting attacked and tankers have been fine for the most part. And so there was one, I think, chemical tanker that got hit, but oil and gas and LNG have been fine. It looks like this might be sort of deliberate, again, understanding that Iran backs the Houthis like they back Hamas financially and with training. And they've actually, I think, had folks in Iran for training, as well as sending their folks to local. I've seen some theories from geopolitical risk analysts that there actually were IRGC officers that were helping the Houthis actually shoot some of these ballistic missiles. Apparently, it's very technically complex to hit a moving cargo ship with a ballistic missile. This was a new thing. I think the most likely impact to the oil market is actually that the container ships, there's going to be more of them in use. So more container ships running means more bunker fuel and diesel and other sort of oil product consumption. and then they're going to be going longer routes. So down through the Cape of New Hope, through under South Africa, rather than through the Suez Canal. So that seems to actually be the most likely impact in the short term. And the calculations are if about half the container ships go the long way, or if about half the cargo goes the long way, that could affect oil demand by a little over 500,000 barrels a day. And that might actually be sort of sandbagged a little. That was, I worked with a couple of retired physical product traders to figure that out. One of them sort of came up with a really specific, slightly higher estimate. Another one sort of had a similar estimate, sort of looked through it and was like, okay, hey, this is good enough. I think it makes sense to put this out as sort of a scenario, a possible sort of outcome. I think that's the sort of biggest potential oil market implication of this right now. I think the thing to watch out for, which is incrementally positive, it's an extra, it sort of makes up for most of the incremental exports from Iran, which had a really big price impact. But I think the thing to watch out for from an oil supply perspective is that Iran has called for a export ban to Israel, and they don't supply Israel directly, but the way they did this in the 70s twice was they basically just stopped shipping oil to 40 or whatever Western countries, so Israel and what they considered Israel's allies, which was like the EU and various other countries. And so that would be, to the extent that you just have a bunch of container ships going the long way, and the U.S. has sent some ships to the area and is saying that we're going to sort of intervene, but we'll see in terms of the potential impact. I don't think there's political will to invade Yemen, and I think it might be hard to stop these missiles without actually invading. Similar to Israel trying to stop Hamas's rockets at their cities, they only seem to have actually been successful in stopping them once they sent ground troops. Even with extensive bombing, there were still many rockets that were getting launched, and launching rockets at an individual sort of ship target allows for much more mobility. And I think it'd be extremely difficult for the U.S. to actually stop. And again, it's not my area of expertise, just sort of reading a bunch of different risk analysts' estimates and their assessments. It sounds like it would be difficult for the U.S. to stop and for this armada to stop the cargo ships from being hit. So it seems like that may actually continue for some time, which would have a demand impact. But the bigger thing is, if it doesn't affect things and it just sort of, we just start living with this like longer trade route, then the next step might be to try to affect oil supplies. And there is this obvious step, and the obvious step, hasn't gotten a lot of traction so far, but, life was pretty good in the Middle East in the 70s with radically higher oil prices after the embargo. So even though they sold fewer barrels, they got a really high price. And after seeing the US drop 160 rigs, after seeing Canada drop a few dozen rigs, after seeing sort of the global offshore boom slow, and, seeing some projects get delayed, some of these OPEC countries might feel comfortable doing this, and maybe they do some sort of backroom deal where, Iran gets to say, we're doing this, and Saudi Arabia denies it, but then everyone cuts a little. And, again, I'm not saying that's very likely. It's just, it is possible. And to the extent that this continues, the situation with Houthis continues, to the extent that the risk analysts are right and they can't stop the Houthis from blowing up container ships, and container ships just continue to sort of go around, it would be a logical next step with sort of some chance of that, which obviously would have a dramatic impact on oil supplies and oil price. And it's not out of the realm of possibility when you look at just the statements from various OPEC officials and OPEC countries. They're very frustrated. They see the futures market positioning. They think that the price is being manipulated. They've said it repeatedly. They see very different economic figures than the IEA, and they seem angry. And in some cases, they're actually friends with Israel. So like Saudi Arabia, like they were on the path towards peace with Israel before October 7th. And from what I read, again, from these same analysts, like they're actually still sort of on that path. but it doesn't mean there's not a chance that you see some sort of oil export disruption. Again, will it affect Israel? Not really. In the same way as it didn't really affect Israel in the 70s. But hey, whatever excuse you need to get 3 times the price for your product while selling 20% less, right? So, not the best long-term plan for oil, could cause demand destruction longer term, could have all kinds of other impacts. But there's not a 0% chance of this. And so I think it's worth considering. And again, like, I'm not going and betting on this, but hey, it's some really nice, interesting right tail optionality. And I think the more people are sure that nothing like this will happen, the more likely it is that something like this happens. And when it happens, the more likely it is that it has a substantial, sticky price impact.
Well, you mentioned that you look at Canada as a stable jurisdiction when it comes to the energy space. I'm wondering what your thoughts are on the Liberal government there announcing they will be capping emissions from oil and gas companies. This is what CBC said. The Liberal government's framework to cap emissions from the oil and gas sector proposes to cap 2030 emissions at 35 to 38% below 2019 levels in order to reach the government's goal of reducing emissions in the sector to net zero by 2050. Should investors in the Canadian oil and gas space be worried?
So everywhere has its risks. There's nowhere that's perfect, right? I wasn't implying that Canada was risk free, just that, relatively speaking, you were less likely to have your stuff actually stolen outright. And there's enough sort of property rights and a long enough history and enough alignment from a provincial level and enough power at the provincial level to sort of protect you in ways that maybe you're not as protected in XYZ South American or African or Asian country, right? I mean, or frankly, Ireland. I mean, the tax they did, just extraordinary. And I can't say it enough, like, watch out, random tech company, random whatever, watch out, right? Like, once you do it once, you're like, hey, this extra revenue plus like going after an industry we don't like, terrifying. So Canada has not done that. They have very strong property rights. You're not likely to have your stuff nationalized. The emissions stuff is interesting. I mean, I don't think Canada's serious about the environment. I think they're serious about sort of exerting colonial rule from the East Coast on the Western provinces. And I think the Western provinces have sort of caught on. And there is a framework for this, which is what Quebec did, which was they threatened to leave. And in exchange for not leaving the federation essentially of Canada, they got all kinds of concessions, and basically, like, people in Alberta work hard and pay taxes, and the money gets sent to Quebec because Quebec essentially, among other things, threatened to leave. So I think people, they know it. They always thought, hey, this isn't the right thing to do. If you look at some of the statements from the provincial leader, the premier, as well as some of the statements from the premier of Saskatchewan, I mean, honestly, I sort of want to, we should annex them, count them as natural born citizens. And I'd love to have the premier of Saskatchewan be the president of the United States. I mean, really just sort of down to earth guy, social liberal, fiscal conservative, states' rights, just sort of what he'd capture the center, 70% of the U.S. and whatever. So unfortunately, that's not obviously a real, there's a lot of issues with trying to do that. But I think Canada's sort of moving actually from a risk perspective safer, not more risky, because as the provinces start to respond to these more and more extreme rules from the East Coast perspective, that are sourced from the East Coast, and are used to sort of make certain Liberal Party voters and NDP voters feel good or whatever, I think it actually reduces the likelihood of them being implemented. And you can actually see, I think there was a carbon tax that Alberta, the premier, is actually instructed to not enforce. And then I think also in Saskatchewan, the premier has instructed their government to not enforce it. So, I mean, that's a huge step. And that's, I think, a very positive step from a geopolitical risk perspective for investors in Canadian oil and gas. So there's still risk. The TMX got delayed again. The rates are going to be higher, so it's going to cost you a little more to get your oil out. Local basis for gas is terrible right now. It's hard to get pipe out. It's taking forever to build the West Coast LNG facility. These are all things, but they're sort of known. They're sort of priced into the equities and have been for a while. And so if anything, I actually think people are sort of overreacting to the downside when they should be getting, I think, a little more comfortable and excited. And, it's Canada. They're not going to end up, well, not definitely, but they're very unlikely to end up in sort of a civil war or any sort of outright whatever. I think the most likely scenario by far is a sort of Quebec-ish scenario where just in exchange for not leaving and not taking more dramatic actions, you end up with a much more reasonable policy scenario. And I think a lot of the premiers in Canada are supportive of that, even if the federal government there isn't. And there's elections coming up. And so if you have a bunch of the premiers in favor of sort of a rational approach towards managing resources in Western Canada, I think you just end up with that as the ultimate sort of policy approach, and it's just going to be noisy and scary in the meantime. So short answer, basically, no, not very worried. If anything, I think it's actually not so bad and maybe getting better, but nothing is risk free, and there's always concerns in any jurisdiction.
Well, Josh, thank you so much for joining us today. It's been an incredible conversation. I learned a ton. Before I let you go, could you tell us about buys and interests? And if there's anywhere else you'd like to direct people online, feel free to do that as well.
Sure. Yeah. So we invest in publicly traded oil and gas producers and services companies and other companies sort of in the oil and gas and energy value chain. We launched in 2015. We've done pretty well, sort of despite the really sort of tough oil downturn for most of that time. And you can find us at bisoninterests.com or at bisoninterests on Twitter.
Great. Well, I'll put links to both of those in the description for people who want to check that out. Thank you once again, Josh, for joining us and sharing your knowledge with the audience.
Thank you.
And thank you for joining us today. As a reminder, this episode is brought to you by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.